Hi everyone, this is Sandeep. Whenever stock markets corrects at a broader level and stocks gets corrected 30-40%, the most common question that comes to people's mind is should I sell the stocks or should I buy more or should I hold? Three questions. And whenever we see that the stocks get corrected like 30, 40, 50s up to 70% from 52-week high, we did most of the investors we tend to think that the stocks have corrected so much, they are so cheaply available now, and it's the right time to buy the dip. But sometimes what happens is when we buy the dip gets dipped further, and it sometimes get into a bottomless pit for some of the stocks. And it's a very confusing state of mind for investors on what to do in such kind of scenarios. But we need to understand one thing, that a stock correction from 52-week high, how much ever it is, does not mean anything to the underlying fundamentals and valuations. It is just that we are getting biased by a most common behavioral bias out there called anchor bias. Anchor bias is just nothing but the first level of information or the first piece of information or data that we have. We get influenced by that data like 52-week high. We have seen the price going up to, say, for example, $400 for a stock price. If it comes down to 120, we think it's cheap because corrected 70%. So look here, I mean, we have a chart out here which shows, clearly the price action of many of the Nasdaq stocks. I mean, tech and biotech especially, and some of the media out there. Entire Nasdaq set of stocks got corrected brutally, I would say, in March 2021 from their 52-week high. Look at the stock prices: Square down 27%, PayPal 25%, Shopify down 30, Twilio down 30, Tesla down 32, and it further fell down after this, by the by. And Zillow fell 38%, Snowflake half got corrected, half, Zoom by half, Baidu by half, Roku 37%, Fudu 44%, Neo 46%. So it's across the spectrum of tech, payments, and media, and all of those Nasdaq stocks got corrected like anything. And one question that comes to our mind immediately is, wow, these stocks have fallen so much, and is it right time to buy the dip? Now, before I answer that question and talk about valuation, let's understand this famous behavioral bias called anchor bias. So, anchoring or focalism is actually a cognitive bias, which is, where an individual depends heavily on an initial piece of information or any data to make future decisions and negotiations and estimations. The two famous behavioral economists, Daniel Kahneman and Amos Tversky, said it in their 1974 paper. People tend to make estimates by starting from an initial value that is adjusted to yield the future decisions. So that value tends to get tethered to our future decision making process. Now, in this scenario, 52-week high acts as a psychological anchor, leading our thoughts to override the fundamentals of companies. We get influenced by the price action at which we started tracking the stock or we bought stock for. Similar is the case for 52-week low. While prices have definitely corrected from 52-week high by a huge extent, as I said in the beginning, it doesn't mean these stocks are cheap based on fundamentals. The other way to look at, is also true. The corollary is also true, which is just because a stock is trading at a 52-week high, it doesn't mean it is costly. Now, let's take an example of Apple stock. Now, I use a valuation metric called free cash flow yield, which is nothing but free cash flow to the market capitalization. And we understand what percentage of the valuation does the company generate as free cash flow. And Apple, in 2009, generated around 7% free cash flow yield, whereas in current situation, Apple's free cash flow yield is almost 3.7 percentage, just half of that, which means Apple is twice overvalued approximately. We cannot compare, it's again apples, not apples to apples, because 2009 situations were different. iPhone sales numbers were different. It was in the infancy stage. No, you're exactly right. Apple's product range, the revenue streams like subscription revenue from services, etc., were not prevalent in 2009, or were not so much in 2009. At least the market is factoring a lot of expectations from Apple's potential earnings at this current juncture. But still, it doesn't deserve a factor of two times difference between a free cash flow yield from these two periods. Now, if this is the case for Apple, many other tech, small to medium companies, size companies, are differing by a factor of 3, 4, 5 times, some even at 10 times. So these are exorbitant valuations, and the stocks are definitely not cheap by any means, although they have corrected by 40, 50%. Now, it doesn't mean that the stocks can't go start going back up again, because there is so much of underlying liquidity and bull market that is driving all the stocks up. But still, it doesn't mean that you're buying the dip. That is my message, which we need to take away. It's a very simple way to overcome the anchor bias, and for that matter, any other biases. The answer was given by Warren Buffett in one of his interviews when he was asked, whether he will look at a stock price in the starting before taking a buying decision. He said he does not look at any of the stock related metrics like prices before arriving at the intrinsic value of the company. He just takes the balance sheet, annual reports, etc., and arrives at the intrinsic value, and then look at the price, so that the price does not have an influence on his fundamental valuation technique. We should follow a similar technique by creating a well defined process oriented methodical approach to arriving at the fundamental valuations of companies. That way, we don't get influenced by any sort of biases, not only anchor bias. So, just wanted to bring that up so that we don't end up making mistakes of buying the dip thinking that it's a dip. Thanks for staying with me.